What's up traders? For those that don't know me, I'm a top author on the TradingView platform and I'm a swing trader as well as running a trading educational company. In today's video, we will be speaking about market structure and specifically we will be taking the example on EURUSD, a trade that I also explained here on YouTube before actually taking it. So you can go and check also that video. And we will be speaking about market structure and then taking that example to explain better how to apply the concept of market structure to real-time market.
Okay, so before going inside of the example of EURUSD trade and showing you how to use market structure, first let's define what market structure actually is. So market structure, or in other words, support and resistance, because they are in some way the same thing, is basically the evolving of price action on a chart. So the market makes an impulse, so makes a push to the upside, then makes a retracement, then makes another higher high, another push to the downside, and another higher low, then another higher high, and another higher low. Now this is how the market moves in an uptrend. So basically creating a series of higher highs and a series of higher lows. On the other side, in a downtrend, the market will create a series of lower lows and lower highs. So basically a low, a high, a lower low, a lower high, and so on. And the alternating of this, of the creation of higher highs and higher lows, or lower lows and lower highs, is what determines where the support and resistance in the market is. Why? Because the market has memory. Now what do I mean by memory? The market reacts to zones in which it has reacted in the past. For example, one of the easiest examples of this and more practical examples is the market creates a high and goes for a retracement. Then it makes another higher high, and when the market goes back inside of the area in which it had found resistance, that resistance will become support and the market will find support around that area, meaning that previous resistance is now turned support. Now why is this? So the simple reason for which the market works in this way is because all the orders that were stacked around this area and that made the market react to it, when the market breaks to the upside, those orders are not anymore sell orders. Those orders are buy orders. Now, do you think I'm speaking about orders from retail traders? Obviously not. I'm speaking about orders from banks and institutions. So that is the reason for which you see previous resistances become support and previous supports become resistances so often in a market, every single day on every time frame. This is a very important concept in the market, and you see this happening over and over again. So market structure is basically this. You see the market find resistance, then that becomes support, and the structure in the market is this alternating of support areas and resistance areas that change dynamically and are basically have memory, because the market remembers where it had the orders stacked, and it will react again to the area and again and again. Now how did we apply this concept for the EURUSD trade that we are in with the students? And if you remember, this trade I had already made the breakdown on EURUSD in one of my past videos on YouTube, and that is the reason for which I wanted to share it again. Basically, EURUSD, the last time we made a breakdown on EURUSD here on YouTube, I told you guys to expect continuation to the downside and that I was monitoring price action with the students for the short. Now, let's speak from a market structure perspective why we were looking for shorts, because now that you know the basic definition of market structure, now let's apply it to real-time examples. So here, the first thing, if you want to identify the market structure in a pair, you need to follow the movements. So for example, here we are on the weekly time frame of EURUSD, and you can see that the market goes up, down, creates a higher high, goes down, fails to find support, and breaks to the downside, creating an M formation. Now after this M formation, obviously we expected the push to the upside, and the push to the upside came. So let's keep following the movements. The market goes up and then goes down, and then again it goes up. At this point, if I am to ask you where is the support, obviously the support is at this area here, because the market went down and then went to the upside, and then the next candle broke the support to the downside. Now after the support was broken to the downside, this support, as we said before in the previous example, this support is now turned resistance, and that is exactly what we see happening here. So what do I mean by this? You can clearly see that this previous support is now turned resistance, and that is one of the main reasons for which we were looking for shorts with the students. So basically, area of previous support now turned resistance on the weekly time frame. Now, another thing that you can do to understand what kind of information you can have on this retracement is taking your Fibonacci on the impulse leg. So let's do it. Let's take our Fibonacci from the high to the low of the impulse leg. By doing this, you realize immediately something extremely important, that the market has rejected the 61.8, in other words, the golden ratio, and has closed below the 50%. Now there's one very specific thing you need to learn about Fibonacci, and especially impulses and corrections in the market. So basically, if you take a simple Fibonacci from the low to the high of an impulse leg, and the market starts a retracement, and it retraces, for example, to the 61.8, which is the golden ratio, and most of the times the market will hit this area and start the next impulse to the upside. So the market will hit the 61.8, and then you will have a first push to the upside, break above the 50%, then you will have a retest to the 50%, then you will break again to the upside, then you will go for a break and retest of the 382, and then the market will start the push to the upside, meaning that the market loves to move by steps. So first one 61.8, then 50%, and then 0.382, and then the real push to the upside starts. So very important to say this. Why do I mean this? Because as you can see, the 61.8 had already hit, and the market closed below the 50%, and then we had the test of the 50%, and that is when we had even extra confirmation that the market was ready for the push to the downside. Now going down on lower time frames, let's go down on the daily and see what kind of price action we got on the daily and how market structure worked on the daily time frame. Now on the daily, you will obviously have more waves in the market, or in other words, more moves. So as you can clearly see, the market from this low went up, back down, creating a double top. Then the market went for a fake breakout to the upside. A fake breakout basically means that the market closed above the area, and then on the next candle the market closed back below the area again. You can see this green candle here closed above the area, and then the next red candle closed back below the area. Then what happened next? The market went all the way to test the lows, and it's very important to say that this was one low here, one low here, and one low here. So obviously a retracement was very much expected, also because the market had created this very strong impulsive phase to the downside without any kind of retracement. Now, if you want information on a retracement, you always have to take your Fibonacci on the previous leg, or in other words, in this case, on the impulse leg. So let's take our Fibonacci from the high to the low. By doing this, you can clearly see that the market has hit the 382, which is the Fibonacci that we expected the market to hit. Also, take into consideration that we clearly have an area, basically a pattern, head and shoulders, left shoulder, head, and right shoulder. Now please keep in mind that most of the times the right shoulder will be lower than the left shoulder. The right shoulder, 90% of the cases, it will be lower than the right shoulder. And on the 4-hour time frame, if you remember, in the last breakdown we have spoken about, we were around this area here. You can go and search it on YouTube. we were around this area here, and we said that we wanted to see the market go back inside of this supply zone here. Okay, very important to say this. We wanted to see a retracement back inside of this zone. And as you can see, that is exactly what happened. The market went back inside of the zone, and you might argue, okay, the market went back into the zone. Why did you wait before taking your entry? And the simple reason for which I waited to take my entry is because we have a lot of rules of the strategy that must apply to a trade before it can be taken. For example, we have a very unique way of determining when the market has changed environment from a bullish environment to a bearish environment. And here, with this push to the upside, when the market was inside of this area, we could not be looking for price action entries according structure and our rules, because the market was on the 4-hour time frame in a bullish environment. So it's true, on the monthly, weekly, and daily time frame we were in a bearish environment, but on the 4 hours we were still in a bullish environment, both from an environmental perspective and also from a structural perspective. Because if you look at the structure in the market, you have up, down, up, down, up. So the market is still creating higher highs and higher lows. So basically, you can't be shorting a market that on the 4-hour time frame is still creating higher highs and higher lows, because it doesn't make sense from a structural point of view. Now, when the market created this very nice candle to the downside, the market shifted from a bullish environment to a bearish environment, and also from a structural point of view, the market shifted from a bullish market to a bearish market. So at that point, on the retest of the previous support, now turned resistance on the 4-hour time frame, we were able to enter the position, also because all the other rules of the strategies were satisfied around this area. Also the stop loss, simply we put it above the 78.6 of the Fibonacci taken on the previous leg, on the previous 4-hour leg, so from the high to the low. And you can clearly see that this was a wonderful trade, now running risk-free, meaning that our stop loss is at the entry price minus 1 pip, meaning that we are 1 pip in profit to cover the commission on the trade, so that if the market now goes back inside of our entry zone, we will be risk free on the trade and we will close the trade break even. So very important to speak about market structure. That is why I wanted to make this video today, because market structure really helps you understand what is the environment in the market. Obviously we have other rules to determine the environment, but structure is important, because when you will have a break of structure, then very often you will also have a change in environment in the market. Now I can't tell you how to do that because it's part of the mentorship program, but I can teach you here how to use market structure to help you in your trading. It's very important to understand market structure. If you don't understand it, then you cannot trade profitably. It's almost impossible.
I hope you enjoyed the video. If you did, make sure you smash the like button and let me know in the comments below if you found this video valuable. It really does support the creation of more free content for you guys, so make sure you smash the like button and let me know in the comments below, as well as clicking on the link to get your free training that I'm linking below. So with this said, I will see you in the next video to bring on the table more free value for all of you.